Tom is the RBC Wealth Management.
Yep.
And Clara is Director of Direct Invest Philanthropy.
Divest Invest Philanthropy.
Divest, what did I say?
Direct?
She's
Close
the
enough.
Director of Divest Invest Philanthropy, thank you.
Back
Back up here, okay. And that's the foundation arm, sort of the divestment movement?
Yes, exactly.
Okay.
Great. Well, thank you for joining us, Clara and Tom. And this panel was originally scheduled to be with Ellen Dorsey, but unfortunately Ellen's had an accident with her computer that crippled her yesterday. And,
Literally.
And she couldn't make it. And luckily for us, Clara happens to be living in Basalt now, and she has worked with Ellen and the Wallace Foundation for the last few years, and is able to step in and help us out. So originally, I had intended to do this panel in a 3-year response to a Bill Moyers TV show where Tom and Ellen went on Bill Moyers and announced the Divest Invest rationale and movement. Back then, there was $50 billion committed to divestment. Today, 3 years later, that number is $5 trillion. So you want to talk about momentum in a subject? I don't know, Tom, what is it? Right subject at the right time?
Yeah, I mean, I guess timing's everything. At the time, actually, with the Moyers, we only had 17 foundations. In fact, if you guys have the slides up, there's a slide. Next slide, please. There's kind of the evolution of the Divest Invest movement. Many of the foundations were funding Bill McKibben and 350.org. And then they funded Carbon Tracker's work, which is, how many people have heard of Carbon Tracker? Probably everybody, right? They're the ex-oil analysts who did the work that discovered that 80% of the oil needs to stay in the ground to keep the temperature below the 2 degrees Celsius level that everyone in Paris, except for now us, and Nicaragua and Syria don't agree with. And then McKibben wrote the great paper that came out, in Rolling Stones. There were 3 of them, but that was the first one in 2012. In February 14, 17 foundations made the move to initiate the Divest Invest movement. In fact, the Educational Foundation of America, John Powers, and some of the trustees are here, are one of the original 17, Wallace Global, which was Ellen's foundation, Park Foundation, Russell family. Are there any other families that were here that are part of the first 17, other than the Educational Foundation of America? Oh, thank you. Green's forward. So they initiate, and then Moyers was like March of 14, where we went on and explained it. And then in September 14, Ellen had been working on the Rockefeller Foundation for about a year plus to get them to sign on. And that's when Steve Hines came on and they presented with David Blood from Generation. And that was the great climate movement, the march of 400,000 people in New York City. And so we kind of had 50 billion at that time, and we got like the Rockefeller bump is what we call it, which was from 50 billion to 2.6 trillion, because when everyone said, look, this is the Rockefeller family, how can they divest? I mean, these guys founded Exxon, right? How does that work? And in fact, one of the reporters, Stephen Hines in his speech said, people ask me, how can we do this? We're Exxon, what are we doing? He goes, well, John Rockefeller was an entrepreneur. He saw that, burning whale oil was non-sustainable, and so he would drill for oil. He goes, if he was alive today, he would realize that burning oil is no longer sustainable. We need to go to renewable energy. It's kind of like full stop. Kind of put to rest all the questions as to how Exxon didn't do it. And then 2000, we got the Rockefeller bump. Then you had the Leo bump in 2.6. Leo DiCaprio came on board a year later. And then, of course, you got the Paris situation to 3.4 trillion in Paris. And then from Paris to now 5.2 trillion. So I guess when people see that this is affecting the entire climate, it's important. They sign up and they realize they have assets that are invested in ways that are destroying the planet. They look to get out. They look to get out of coal. They look to get out thermal, tar sands, and then they're looking for oil in the whole supply chain.
I think it's really important, too, to give credit to the students who
Yes.
began this movement. In 2011, the climate movement was really fractured. It was broken after the failures of Copenhagen in 2009 and the failure of cap and trade in 2010. And really, the movement was they were lost. They didn't have a way forward. They had tried all the top-down mechanisms, inside policy discussions with top regulators, trying to get policies passed on a national and international level. All of those top-down measures had failed. And a Harvard professor named Theda Skocpol did a great post-mortem analysis where she said, we had left the most important resource on the table. We had left the people power on the table. A civil society energized by the near-terminal phase of the climate crisis was what was needed. They held the key. And the lock that they were going to open was that divestment. And within 4 or 5 years, we had something that started on 8 college campuses in the US in 2011, mushroomed to hundreds of student campuses around the world. And that then spread to other sectors. It was no longer just the students. People of faith, churchgoers, people that belong to public schools or universities, they all decided to join the fight. They also turned to their city regulators who manage pension funds for their pensioners and decided that's our money. We have every right to control how that money is allocated, and we no longer believe that it should be invested in these fossil fuels. And so what happened was really remarkable on multiple levels. It started really as a moral call. It's wrong to invest in companies that are destroying the planet. That's effective for campaigners, but not so much for the hard-nosed money managers for whom the bottom line is the only God. But in the past 5 years, that moral call has been joined and buttressed by powerful financial and legal arguments. King coal has been dethroned and investors have lost billions. Oil and gas prices continue to struggle, and many point to the wholesale structural decline of the industry as EVs, efficiency, and alternative fuels start to really shrink the demand for oil. Global financial regulators, from the Carney-Bloomberg Task Force to the Bank of England and others, now warn of stranded fossil fuel assets as material risks that prudent investors and prudent fiduciaries must consider if they're going to fulfill their fiduciary duty. So ironically, as we started this movement, one of the biggest obstacles was the claim by trustees that they had a legal duty to fully diversify their portfolio across all asset classes. That argument now, with the help of a lot of legal scholarship and financial regulators speaking of stranded assets, is being flipped on its head. And a recent Mercer and Center for International and Environmental Law report said that we are now entering the 3rd phase of divestment, where it's no longer a moral or financial-based case, but there may be a legal obligation to divest. And that's going to be the next step change that allows us to potentially unlock the next $5 trillion in dollars from the very big money managers like pension funds, banks, and insurance companies, because they may not be swayed by moral arguments. They may be able to, wriggle out of the idea that the titans of the fossil fuel industry are now laggards. They may have excuses. But when it comes down to the legal gauntlet, this idea that it's going to be your legal duty to divest in this time of climate change, there's not much you can do with that. And there's extremely exciting new scholarship focused on this idea of indirect discrimination, whereby pensioners today are getting artificial boost as compared to pensioners in the futures if you continue to invest in fossil fuels. And so there's exciting legal strategies being put forward by our friends at Client Earth in the UK that eventually will see the light of the courtroom and truly start to take this argument from the moral and financial to the strictly legal. And that's when we can see a whole opening of floodgates for this divestment movement. And we believe that we can double this $5 trillion commitment to $10 trillion within the next few years.
Great.
Excellent.
Wow. So, I just want to mention that when Ellen had to call and say that she couldn't make it, we talked about maybe next year she'll come and we'll talk about reinvestment. But I want to address that right now because, taking $5 trillion out or even $10 trillion out, and remember, folks, it's an $80 trillion annual GDP that we have in the world. 80 trillion per year. So, and the USA is the #1 economy, China's #2, and you can just look at all the rest of the statistics about who owns that money. But in terms of reinvestment, how much, let's just begin with how much of that 5 trillion or even the 50 billion that we started with 3 years ago has been reinvested where, and how is that working?
Well, I think the investment side is very important, okay? It's one of the disruptors that is going to lead to this transition. I mean, here's some of the risks of owning fossil fuel, and I'll get to the technological risk, because the technological advantage of doing clean tech is, as you point out, Clara, stranded asset risk is still not trumped. Litigation risk temporarily may be trumped, but people will still sue. Carbon pricing, we might need some sort of carbon pricing, because God knows we're giving money away by cutting taxes to everybody else. Someone's got to make some money for the government to survive. So you might have to do a carbon price of some type or a tax. Regulatory risk is trumped, because Scott Pruitt's going to stop everything the DPA is going to do. Peak demand for oil, though, definitely not trumped. The major oil companies don't see peak demand for oil happen until 2050. Think about that. Owning a management team that is not planning for peak demand for oil until 2050.
Although Shell and Statoil are actually looking ahead and saying it could peak within the next 15 years.
15, okay, maybe, okay. Technological risk is also not trumped, okay. But the vast majority, I mean, Shell and Stat, those are non-US based oil companies. I mean, Exxon and Chevron are nowhere near. These guys may be some of the leaders from that perspective. So the question is do you need, legally it's nice to get people to divest, but the market should actually create that change quicker if it responds more rapidly to this. So let's look at what energy's returned. How many people here have divested themselves? Okay, because if you haven't, and let's say you just throw money into an index fund, okay, here's your lagger in the index fund right there. 5-year number for energy, 1.7% return. Okay, worse than bonds. Okay, it's volatile death. Down 23 and 15 because oil prices went from 100 down to 26 bucks. They run up 23% because it goes from 26 bucks up to 50. Everyone thinks it's going to 75, right? Oh, wait a minute, it's not going to 75. Down 7.3% through the first quarter. It's actually down 10. So the question then is, if you're still in oil, what's kind of inspiring you to underperform? Right? And it's not just the stranded asset bubble that all these companies have carbon reserves on their balance sheets today where they can't monetize 80% of them. There's one bubble. But there's actually another bubble in energy. Do you know what the price earnings ratio of Exxon is today? 34. 34. Okay, why? Because all these analysts say, oh, it's going to 75 bucks. They're going to make a boatload of money. They're going to make it all back. Well, guess what? Do you know what their dividend rate is? It's over 3 bucks. It's 3.08. You know what their earnings are? $2.40. So they're now borrowing money to pay for their dividends. Okay, so your bubble, you have one bubble in the current price of where Exxon is today. You have another bubble in the fact that Wall Street's not even thinking about, and they're not going to be able to monetize 80% of those assets that are on their balance sheets today. So the bubble in the stock market is actually in carbon-based energy. Oh, and by the way, it's only carbon-based energy in the S&P. There's no wind, there's solar companies in the energy sector in the S&P, not a single one. It's all 100% carbon-based from that perspective. So let's get to some of the ideas of the technologies creating these solutions. So solar's is up northwest quadrant, wind, battery storage, LED lights, all have dropped 80 to 90% in the last decade. Huge drops in price and huge adaptation associated with that. And this is the part that Trump can't stop. Because this type of dropping in pricing with adaptation is what's going to lead to the shift from burning a carbon molecule to produce an electron to using renewable energy to produce that electron. Battery storage is the holy grail. Once you get battery storage in place, you now can deal with the intermittency of solar and wind, and you can store power. The Tesla gigaplant will be done soon. China, Korea, and Japan, horrible allocators of capital, I might add, are busy building huge battery plants that are going to make the Tesla plant seem, kind of like an afterthought. And when they come on, you're going to see prices of kilowatt way below $200 a kilowatt hour for storage. And you need $200 a kilowatt hour for utility scale storage, according to Jim Rogers, who used to run Duke Energy, said in a public forum, it needs to go below $200. So when that happens, you're actually going to get more and more adaptation pushing because you've got pricing models doing it. You can go to the future. I'm going to jump ahead here a little bit. Here's some other reason for renewables. Jobs. Jobs in every single district. Not just where you have fossil reserves. More jobs, as we'll see in a minute, than in the carbon market. Market adaptation. Companies continue to adopt this. Major companies are going renewable. Healthcare costs. I think Rocky Mountain Institute's here. They've done studies where they show, look, you could literally pay every miner a bunch of money to retire, and that would deal with the healthcare costs on an annual basis of the pollution associated with coal, burning coal low wealth communities. National security, centralized grid structures, a key concern of the CIA and the FBI. A tree went down in Ohio, took down half the eastern seaboard. Immigration, let's talk about Trump. Let's talk about SHINE, energy access for all. If you give energy access to people where they live, they will stay where they live and they will not immigrate because they can improve their standard of living there. The sun can do that. Oh, by the way, and then there's a climate change issue. Really?
No.
Okay, but let's talk about those issues Trump knows about. So here's your job numbers. You employ jobs? 200,000 jobs in solar, 80,000 plus in wind. You know, that's 300,000 jobs and growing. Coal's obviously in decline. Here's the companies that have adopted 100% renewable by 2014. Why are they doing this? They're not doing this because, yes, it is great for their brand to do it, but they're doing it because it makes economic sense.
Yep.
Right? The cheapest form of power. If power is your second largest form of capital allocation, if you're a business manager, okay, you're running a business, you have human capital, and then you have electrical costs. You're saying, well, if I can go lock in for 20 years solar and wind, and by the way, in Dubai, they just signed 2.4 cents a kilowatt hour for solar. Okay, in battery storage, linking it now with the high price of batteries, it's 10.4 cents in California. Battery and solar combined. Okay, they're saying this is a lot cheaper than opening up to the volatility of fossil fuels and natural gas. You cannot get a natural gas CEO to lock you in at a 20-year power purchase agreement at 4, 5, 6 cents a kilowatt. But you can in solar and wind. Salesforce, net zero emissions, Apple, Invest, Infosys, Walmart, Google, Unilever, many, many more. So the companies are going to continue to push for renewable energy, whether the market does or not. There's the Tesla gigaplant, mile long, covered with solar panels. Here's the new power generation capacity for 2015 in the United States alone. Do you see any carbon in there? With natural gas is a third. There's no coal anymore. So they can get rid of the clean power plant all they want. But there's not a single utility that's going to build another coal-fired power plant. Why? Because it's a 40-year investment. And it makes no economic sense in the face of renewables and energy efficiency. And they're all listening to Amory Lovins and Hunter Lovins now at RMI, thank God, and Bill Becker, and talk about energy efficiency. That's why they're not going to do it. They're not going to put money into a coal-fired power plant. And there's more jobs on the renewable side. California, 6th largest economy in the world. You know what? You can't grow an economy if you go to renewable energy. You just can't do it. Really? Well, since 2000, California's grown by 2% annualized, which is more than the United States has grown. And we've actually reduced our total emissions by 5% per year. Last chart. For every $1 trillion of GDP the California produces, we do it with 50% less carbon than the United States in general. So here you have the 6th largest economy in the world. Oh yeah, and by the way, it's run by Democrats. Democrats, fiscally responsible, balanced budgets, the whole 9 yards. Okay? It's fiscally conservative, it's socially progressive. Maybe that's what people are looking for. In a way that provides jobs, provides growth, in a way that doesn't destroy our environment, because if you don't want a regulated economy, just go to Beijing and Shanghai and see what the air looks like. You breathe a ton of it there. And you can do it in a way that grows economies and does it efficiently and produces jobs.
Well, you know, it seems, Tom, that we've made great headway in 3 years, at least in terms of the Divest Invest movement. Of course, you know, when I first got involved with AREDAY, I think there was 2,500 megawatts of wind installed capacity in the United States. And today, I think it's far exceeding 100,000. Yep. Okay, that's in 14 years. And the growth curve is continuing. I mean, solar has just come on with China reducing the cost of panels by 75% in the last 5 years. And that's allowed companies like Solar City and many others to thrive and survive. So,
which is now Tesla.
Well, yes, and especially with the new. I mean, look, what can you say about Elon Musk? I mean, the guy has just got some vision, and he's willing to put his money where his mouth is, and then bet the bank.
But despite all these great tidings that are coming from people like Tom and from Elon, there's still a massive opposition girding by the fossil fuel industry against divestment. Yes. As much as this movement grows, the opposition grows ever bigger. Just last month, there was an API-funded report that said that divestment poses grave risks.
American Petroleum Institute.
American Petroleum Institute, thank you. Sorry, no acronym zone. That divestment poses grave financial risks to investor portfolios. And we've since gone through that with the help of Tom Sanzillo at IEFA to rebut each of their points. And it's very clear that they're running scared. And the fact that their opposition keeps growing is a testament to our winning. And even small things like Peabody Coal last year put in its security filings that divestment was a material threat to their business. As the divestment movement and the sort of breaking down of the social license of the fossil industry continues to come about, you see things happening like Coal India in trying to fill its IPO last year, struggling to find investors because coal is no longer a socially acceptable investment. So these changes are happening. They're happening sometimes slowly, sometimes quickly, but it's remarkable. And campaigners are becoming ever more sophisticated. They frequently link up with financial experts like Tom Van Dyck, Tom Sanzillo, Keith Ambach-Shear formerly of Mercer, and they get down to brass tacks to address the arguments that opponents are making. And most of those arguments are based on this false notion of financial underperformance. The divestment will curtail returns, and as a fiduciary, that is your duty, that is your obligation to maximize to the best of your ability. But the experience of institutions that have committed to divestment runs contrary to all of these red herrings. Many, for example, sidestepped the coal crash that hobbled the international coal industry, now recognized to be in structural decline. In the US alone, 50 coal companies went bankrupt between 2012 and 2016, wiping out billions in equity and bond values. Oil and gas are next, as a range of credible analysts, including some of the fossil fuel CEOs themselves, predict that oil demand could peak within the next 15 years. Campaigners are also more sophisticated now because they have new tools, such as the decarbonizer tool, that allows you to plug and play an investor portfolio to show how much they would have lost or gained had they either divested or remained invested in fossil fuels. And one concrete example of that is the New York State's pension fund, which is $175 billion, the third largest in the country. A March 2016 report found that the fund would have had an additional $5.3 billion to give to its retired employees if it had divested from fossil fuels and reinvested in clean energy instead. That loss would have made each of the 1.1 million pensioners more than $4,500 richer and could have helped the state cover nearly 12% of the costs following Superstorm Sandy. So these financial arguments are becoming more and more powerful. Campaigners are more sophisticated now. And this new wave of fiduciary duty argumentation where there may be legal consequences for not divesting really can be the next step change for reaching 10 trillion.
It's good news. I want to hit it right where the heart of the beast lives. Okay, so let's go right to Wall Street now, and let's go to the big firms and the analysts that are recommending the buys and the sells, and the quarterly profit returns that the SEC mandates for the corporation's bylaw, right? And the fiduciary responsibility involved, and see how does this movement, how can we begin to influence and really go at the heart of the beast.
So one thing that's under attack right now is shareholder engagements have been very helpful to bring dialogue to management teams of these companies, okay? A number of groups, religious groups, major institutions like CalPERS, CalSTRS, the As You Sow Foundation, we bring these resolutions to Exxon to say, well, how are you gonna handle, entering a 2-degree world? What's your plan? Okay, well, there's something called the Financial Choice Act. How many people have heard of that? Passed the House, it has not passed the Senate. There's a clause in that act, which is dealing with the Dodd-Frank financial reform, that says that you need to own, right now, you need to own $2,000 worth of a company in order to bring a resolution. You need to own about 18 months in advance of an annual meeting to be able to bring a resolution or start dialoguing with a company. They're changing that to 3 years ownership, and you have to own 1% of the company. Okay, so if you do the math on like Apple Computer, it's like $7 billion. And so there's only 7 entities that own that much Apple. So what they're doing, not unlike what they're trying to do with campaign finance, where the rich get to buy the offices, now the rich are the only people that can communicate with the management teams of these companies. So CalPERS, CalSTRS doesn't even have enough money. New York State Teachers Retirement System, with help with the Exxon situation, don't even have enough money to bring these messages to these management teams, okay? So we need to deal with the Financial Choice Act. The reason I bring that up is because when you're dealing with banks, one of the things we've been doing with banks is like, okay, let's fight pipeline by pipeline. Well, that's a nice strategy, but you win the pipeline battle, then what do you win overall? What's the big picture that you're focused on as an environmentalist? What's the end game? The end game is to keep the carbon in the ground and become carbon neutral, right? So instead of getting in this deal by deal fight with the investment bankers who are literally the crack addicts of the, the financial industry because they're deal by deal, they don't really care what the deal does, right? Sorry for any investment bankers in the audience. You can go get your hit at the Green Cross. But no, just kidding. That's off record. I'm not here as RBC.
Well, we do live in Colorado. So.
But the point is that we can now talk to banks about, and there's a shareholder movement to do this, to say, what is your plan to become carbon neutral by, say, 2030? So that way you don't need to get into a deal-by-deal thing. Mind you, Dakota Access was clearly environmental racism and never should have been built. But if we start fighting pipeline by pipeline, it's not going to accomplish, you may win battle and battle, but the war is being carbon neutral. So you say to a bank, and through a shareholder engagement, is look at, what is your plan, just like we're kind of doing with the fossil fuel industry, for going carbon neutral, scope 1, 2, and 3, for carbon neutrality by, say, 2030. Come up with a plan. You can do this pipeline, but are you going to do $250 million of renewable energy credits? Okay? What does it look like? Come up with that plan, say by in the next year or two, and figure out how to make that work. And that way, if you have the bank financing mechanisms moving in that direction, okay, you now will be putting that kind of cap on the idea that they're going to kind of mitigate what they're going to finance. They're going to do some good and some bad, and obviously do less bad and more good, but going forward. And that way, the management teams of some of these companies can actually deal with some of these bankers like, I want to do this deal. Fine, what's your offset? And they can have that dialogue. And we as shareholders then can have a discussion, or as environmentalists, where our end game gets accomplished, which is carbon neutrality, not just deal by deal, pipeline by pipeline.
It's interesting because for a long time, the divestment advocates have sort of pitted themselves against the shareholder community. And we're at a new era of shareholder engagement where for the first time, you had 2 U.S. oil companies have majority votes in favor of climate risk resolutions, one at Occidental Petroleum last month and one at ExxonMobil. Right. And those were huge, significant victories. And no doubt also propelled in part by divestment pressure to be ever more ambitious in your asks to the companies. But I work closely with the New York divestment community, and they have decided to hold a very hard line that at this point in the late stage of the climate crisis, years of studying, years of reporting on potential climate risk is not where we need to be. One of the campaigners was quoted as saying, we need ExxonMobil to stop burning fossil fuels, not studying how it's going to be impacted by climate risk going forward. Valerie Rockefeller Wayne from the famous family, she herself said, after having decades of experience working with Exxon, trying to move them as a shareholder, she wrote, we know firsthand that shareholder activism is a losing strategy with Exxon. The company has a long history of talking the talk on climate while walking the other way. The notion that they're going to shift their core business in response to shareholder activism is naive. So there's going to be, it's a bit of a clash of titans now between the two movements, and I think that actually rather than being adversarial, we should look at the inside-outside opportunities here, because these new shareholder majority votes are hugely significant. They mean that the ball is moving forward. Yes, Exxon could continue its game of delay and say the right things and act differently, but there's no question that there's power to what's happened this spring, and I think the divestment movement would be wise to try to find synergistic ways to right. collaborate and keep the pressure on in the right places while recognizing the merits of things like the Mark Carney Bloomberg Task Force, recognizing the merits of these new disclosures, right. which really do have an opportunity to shift culture at the insides of the industry.
No doubt, and there's an interesting clause in that Exxon resolution, which is that they don't do anything and they do walk backwards or say one thing and do another. The major investors are going to start voting against the boards. And that clause is not in the Oxy petroleum resolution. And it's the first time they've inserted it, where you're going to see things like BlackRock, CalPERS, the major institutional shares will vote against the board members if they actually don't start taking concrete steps within the next year. So you're going to start talking about them, how are they going to take over the boards? But we have to be careful because, once again, this Financial Choice or Financial Wrong Choice Act needs to be kind of dialed back. Now, they say it's not going to pass the Senate, but we got to make sure that as shareholders, that's kind of a check and balance in a publicly traded environment where these stocks are publicly traded and the management team is accountable to the public, which is basically not, Bill Gates and George Soros, but it's actually the teachers and the government employees of the world, the people. And we need to keep that dialogue possibility open because that's some of the best ways in which we get information to these management teams, and they learn.
Well, in a world where the private sector is taking the lead now, and the federal government seems to be, just sort of advocating for, more fossils across the board, we've got to come up with some strategies like you're describing that are really going to make the difference. I think in the last few seconds, maybe if there's anybody that has a burning question for the experts up here. John, you want to?
Tom, you talked about the banks taking a look at their investment strategies. Sorry.
Yep.
John Powers with Clean Capital. You talk about the banks looking at their investment strategies and putting out a climate plan towards addressing that. Are there any banks that you see that are leading on that right now?
That's a great question. I mean, Royal Bank of Canada has called for a carbon tax. So we're at that point at least saying we're in favor of a carbon tax. But no, as far as I know, there's no major bank that said, okay, we're looking at carbon neutrality. I've talked internally within RBC, and they're like, okay, we got to figure this out. The Equator Principles, who do we, UNPRI, who do we work with to try to track this? Scope 3 isn't really clear yet. Scope 1 and Scope 2 they could do, so you could start phasing that in. The discussion has been brought up by people like Walden. I don't think anyone from Walden Asset Management is here. But there's other asset managers that have been bringing this forth. But it's just starting.
And while they're not a multinational bank, there is a significant U.S. bank that services mostly unions called Amalgamated, which has made its commitment to divest and invest. What's really, back to your question, Chip, about how much of these divested dollars have actually moved, it's a tricky question to answer. And many of the sectors so far have been focused on divestment only. But Amalgamated, the members of Divest, Invest, Philanthropy, they have both made a commitment to not only divest, but invest a portion of their proceeds in climate solutions, broadly defined. And that's the trend that we're seeing to develop. And more and more interest is also surrounding the regenerative economy, a just transition, and more and more campaigners are discussing ways that divested dollars can be put directly into these sort of just transition initiatives that will create a truly sustainable path forward that works for many and not just the few.
Good, and hopefully we can have a larger talk about that in 1 year from now with when Ellen, and you'll both be invited back for that panel. Hank, you get the last one.
Dutch people sued the government and won.
Can people sue the government?
No,
Dutch people sued the
Well,
government
Dutch?
and won. They sued the Netherlands, and they won. So they sued the government because the government's not doing enough about climate change. And so they forced the issue through the courts, just to give you another legal angle. So that's a real good, and they won. It's 800 something people, and they won. The second thing is you mentioned, carbon neutral, and I think we're entering an age now where we need to be carbon negative. And so if we can do, Rod, where's Rod? So what I'm thinking here is that we need to have carbon negative tax credits. So if you get a company like
megawatts
Apple,
and not megawatts. Yeah.
If it goes, if a company goes carbon neutral and then goes carbon negative, they should get tax credits.
Yeah.
And I think that would be a good way to go, and that would give all these people who are doing carbon sequestration technologies a place to put their
let's not
technology.
talk about carbon, not carbon sequestration.
One of our,
I don't think carbon sequestration exists.
One of our campaigners
Okay.
actually one of our campaigners in Sweden has actually made the case that we need to start shifting from Article 2 of the Paris Treaty to Article 4, which is the one that talks about carbon neutrality by 2050. Talking about terms of limiting climate change to 2 degrees, it's so vague, it can be so esoteric, but really what we're aiming for is carbon neutrality / negativity by the middle of the century. That's got to be the goal.
Yeah.
That's gotta be the
2030.
goal.
Okay, sorry, we got to go.
Thank you.
I'm glad you guys came, and hope everybody
There's one more
learned
question.
something.